It's another beautiful day to do business. 55 minutes of current and relevant business conversations. That's what we have prepared for you here in Business Morning. I'm Ini John Mekwa, and we start from our normal space, which is the global oil space prices. Today we see edge lower, but remain well above the $100 per barrel, as investors are weighing mixed signals from the President Donald Trump, on whether he will resume military strikes against Iran. Mr. Trump had told reporters that the U.S. might have to give Iran another big hit. His renewed threat comes after he said that he called off an attack scheduled for Tuesday at the request of the leaders of Qatar, Saudi Arabia, and the United Arab Emirates. He also said that Iran has a limited period of time to agree to a deal. He says that Tehran has 2 or 3 days, maybe Friday and Saturday, sometime early next week. So all of this has led to this drop, almost 1% for Brent, and the price is still, as I said earlier, more than $100, $110.24. WTI is also above $100 even after it dropped more than 1% in the last couple of hours. Brent and WTI settled 2.6% and 3.6% higher, respectively, in the previous session. That's notching their 6th positive trading day in 7 days. Both contracts have advanced more than 50% since the war began on February 28. To a market here in Nigeria, still a positive market for the NGX. Yesterday, the market closed more than 0.5% in the green, and it's gone up to 251,000. Opened this week at 250, but we see that in 2 trading days, it added more than 1,000 to that all share. And then for the volume, value, and deals, we saw they dropped compared to the previous day. For top gainers, FTN Cocoa is still doing good, looking attractive to investors, as well as Zikis. Japan Gold is back in the picture. It's been away for a while, but investors are looking that way again. So we saw a gain of almost 10% on Japan Gold at the close of trade yesterday. Unilever, however, is on the flip side. Unilever, Transnational Express, and Sovereign Insurance, they were the losers at the close of trade yesterday. Top trades had Access, Linkashore, and Sterling NG. Sentiment around Access is still something to look out for, but we see the price still around 25 naira. We've seen it at 30, but I'm sure we'll get there. Investors will forgive Access for not paying dividends, and then more people will come on board. Now, from the stock market to the fixed income market, the Debt Management Office says it has raised about 614.5 billion naira from the month's 600 billion federal government bond auction, with investors showing stronger appetite for the longer tenured paper. According to the auction result that was released by the office, the funds were raised through 22.6% January 2035 bond and the 16.24% April 2037 bond, and both are reopened instruments with an offering of 300 billion each. Details of the result shows that 22.6% January 2035 bond attracted a total subscription of 262.23 billion naira, while 130 bids received, but 79 bids were successful, while the April 2037 instrument recorded 135 bids, with 96 bids accepted by the DMO. Now, Africa is set to receive about $6.4 billion annually in investment guarantees from the Multilateral Investment Guarantee Agency, and it's part of efforts to boost private capital inflows into the continent. The guarantees will de-risk investments across key sectors, including energy, infrastructure, trade finance, and digital connectivity, making it easier for investors to fund large-scale projects. Officials say that the expanded program is aimed at mobilizing private investment, supporting job creation, and strengthening economic growth across African economies. The move comes as multilateral institutions step up efforts to crowd in private capital into high-risk but high-impact sectors. And yesterday, I was out on the field because 4 years after the launch of the Deep Blue project, the Nigerian Maritime Administration and Safety Agency, that's NIMASA, are highlighting progress in tackling piracy, sea robbery, and other maritime crimes across Nigeria's waters and the Gulf of Guinea. Well, I was at the Navy town yesterday, and there was a bit of demonstration as well as the ceremony for graduates, new graduates who will be fighting pirates for Nigeria. About 5 years since the Deep Blue project started as a major maritime security initiative by the federal government through the Nigerian Maritime Administration and Safety Agency, NIMASA, they staged a demonstration of how piracy, sea robbery, and illegal activities in Nigerian waters and in the Gulf of Guinea are being fought. This is what the 177 new graduates that make up the 2026 Deep Blue Maritime Training Programs project will be doing.
"33 special mission vessel officers, 14 special mission vessel engineers, 107 fast intervention boat drivers, technicians, and boarding team, and of course, 23 helicopter team.
They will, as usual, be stationed at the Command Control Computer Communication and Intelligence, that's the C4I Center in Lagos, and they'll be operating 24/7 to monitor the exclusive economic zone.
The Deep Blue project is a classic example of interagency collaboration. And just like a scholar once said, national security at its core is about interagency collaboration. Therefore, the maritime environment continues to face evolving threats which demands professionalism, cooperation, vigilance, and continuous capacity development among maritime security personnel.
All parties in the project, including the private sector player, HLSI, are proud of their achievements so far and promise to sustain the momentum to build a safe and prosperous maritime sector in Nigeria. It's MPC decision day here in Nigeria. The meeting started yesterday. Yes, it's an unusual look. Normally it starts on Monday, and then we have the decision on Tuesday. Well, Mr. Kaduso decided to paint a different picture this time, so it started yesterday, Tuesday, and today we would have the decision. Now, just before, or hours before that, we know at this time the meeting is already sitting, or they started yesterday. Obviously, they should be working on concluding today. But let's try to find out some of those factors that the meeting, the MPC Monetary Policy Committee meeting, would be discussing at this time to reach a decision which should be announced later about 2 p.m. today. So let's try to get into their minds and see what's happening. And, well, the factors are quite obvious, factors that they will be considering. They're quite obvious, and a lot of it is not just limited to Nigeria. It's spread all over the world. Obviously, we know by now Iran and the United States. So it should be mostly the resurgence of inflationary pressures. We saw that in the number, the reversal of Nigeria's 11-month disinflation trend, an uptick in the CPI. We saw that. NBS would like to emphasize that month-on-month inflation dropped, especially for food and core inflation, but headline rose up to 15.69% from 15.38%. There's supply-side bottlenecks. The Center for Promotion of Private Enterprise, you know, Dr. Mude Yusuf, he's always here, is emphasizing the current inflation is structural, and it is actively driven by escalating transportation costs, logistics deficits, agricultural insecurity, rather than what would normally cause inflation, which is excessive consumer demand. And then another factor is the global energy volatility and geopolitical frictional factor, obviously coming from the Straits of Hormuz and every connecting matter there. International crude oil market shocks. We've seen the numbers. In spite of a more than 1% drop, is still above $100. And that drives down to domestic fuel spillovers. The pass-through effect of that global friction pushed domestic petrol prices up by more than 50% since it started late February, elevating baseline operating costs for Nigerian households and businesses. And then, of course, this spills to businesses. Contracting PMI, Purchasing Managers Index, that has gone down to the contraction area, which is less than 50. The last we saw were 49.4 points, and that, of course, signals a contraction in business activities, factory orders, and output. And then the CBN itself, they did carry out a survey, and public demand is asking CBN to cut rates. Yeah, 63.3% of Nigerians want a reduction in interest rates to lower borrowing costs. But how realistic is that? That's another story. But that's what Nigerians want. But we have World Bank and global institution partners. They're advising the CBN to maintain a tighter monetary stance. I wonder which way the CBN will go to, whether it's to the people, more than 63% asking that there should be interest rate cuts, or global institutions like the World Bank saying that CBN should maintain tighter, even tighter than what we have. They anchored this on long-term inflation expectations to guard against premature easing to defend the Naira. And of course, the CBN also wants to defend the Naira. It's part of what they would like to do, to defend the Naira. Holding the policy rate at 26.5% will keep real yields relatively attractive and bring in some of those foreign inflows that we're looking for. And also talking about that, to reserve retention. We've seen drop in our reserve in the last couple of announcements, which is about a week or so or more. And of course, the CBN would want to reverse this. So these are the factors before the MPC. Let's find out what Mr. Tilewa Adebajo thinks about it. He's the Chief Executive Officer of VCFG Advisory, joins us virtually from Lagos. Mr. Adebajo, good to have you on the show. Good morning and welcome.
Good morning. How are you?
I'm good. Thank you so much, and welcome to the program. So there's so many things to consider. I think the biggest of the two will be inflation on the one hand, economic growth as usual on the other hand. The World Bank advising the CBN to maintain a tighter stance. More than 63% of Nigerians asking the CBN to cut rates. I mean, is there a middle ground to this?
Thank you very much, and good morning. We have to understand what is going on in Nigeria at the moment. And I think that the monetary policy reacts to the environment that it meets itself, and in order to ensure financial stability. The CFG Advisory put out its first quarter report, and the title of that report was that the reform gains, economic reform gains, are under threat. And why do we say that? The biggest challenge we have in Nigeria today, apart from the global oil shocks with the increase in prices as a result of the Gulf War, is the fiscal side of Nigeria. Nigeria's expenditure profile and its revenue profile have significant mismatches. We have a 35 trillion naira deficit with the current budget, and there are no means to finance it. As you said in your opening segment, the DMO raised an extra 600 billion this year. So the borrowing of the DMO this year between January and May is already probably close to 9 trillion. The whole of last year, the DMO raised 10 trillion. So the borrowing now already exceeds 2023 and 2024 levels, and it's already at 90% of last year's borrowing. Now, this is a source of concern. At this rate, then it looks like the government borrowing to finance its deficit is crowding out the private sector, and it's going to compromise growth, and it's going to threaten the reforms. On the positive side, the one of the rating agencies improved our rating by 1 notch, which is still not at investment grade, and still 1 notch below the best rating Nigeria ever had, but we're still 5 notches below investment grade. It's a positive sign. It will definitely reduce our cost of borrowing, but the warnings the rating agency gave to Nigeria is very simple. If you continue to manage your fiscal side properly, because there's a fiscal problem, if you don't manage that properly, and if you destabilize the FX regime, we will downgrade you. If you ensure fiscal discipline and you maintain your foreign exchange stability, we will upgrade you. So I think that is the key warning. So going into this Monetary Policy Committee meeting today, we find ourselves where, as you said in your opening statement, we've had 15 consecutive months of disinflation. And now that inflation has gone up from a high of about 30% about 2 years ago down to about 15.68 now, we're having a challenge because of the cost push factors with increasing petroleum prices, which has translated into 50% in the increase of prices of fuel and over 100% in the prices of jet A1 aviation fuel, as you said, leading to cost push pressures on the supply chain and transportation logistics. So this, we're already beginning to feel the impact. So the question is, given these scenarios, what does the central bank do? Having said that, I think you know that inflation is at 15.68%, and the MPLR rate is about 26.5. So the central bank already had a massive cushion. In any economy, you want real rates to be positive. And our real rates are positive to the level of about 11%. That's the difference between the inflation rates and the of 15.65 and the MPC rate at 26.5. A lot of people had expected that the central bank would drop at least the rates to about 20%, since inflation is about 15.6. So that 11% that you're looking at, that differential on the premium of the real rate of return, might be as a factor of maintaining exchange rate stability. So invariably, given this situation and given the fact that inflation is just inching up, we are projecting at the CFG advisory that inflation will be 20% by the end of this year, by the time you see all the throughput coming through, because it's going to take at least another year before all this crisis resolves itself as a result of the closure of the Strait of Hormuz and this Gulf War going on at the moment. It's going to take at least a year before the oil industry recovers. So I think given that, I think we are projecting inflation at 20% by year end. So the MPC, what we'll expectations is that they're going to hold rates because they have a huge 11% margin between the rate of inflation currently and the MPC rate. So I think the stance will just be to hold. Okay.
All right. But, you know, there's a perspective that we know that, I mean, as you also noted, we had disinflation until the Middle East war. But the Middle East war is not totally negative for a country, a crude exporting country like Nigeria. There are some gains that have come from that aspect. Perhaps if the fiscal authority had found a way to push some of those gains to buffer, you know, the microeconomy, then perhaps the inflation surge wouldn't be so much of a threat. I wonder if you agree with this perspective.
Not really. I think the fiscal authorities need to take a look at the way they're doing things. At the moment, the budget that has been passed is in violation of both the Appropriations Act and the Fiscal Responsibility Act. The deficit of 35 trillion, because 10 trillion was added to the budget before it was passed, and the budget already had a 25 trillion deficit, and there was no commensurate revenue to add to that. There was no source of revenue. So if government keeps making all these over-ambitious budgets and do not have the commensurate or revenue to fund it, then we cannot continue to fund recurrent expenditure with, we can't continue to borrow to fund recurrent expenditure. The debt to revenue ratio has dropped significantly. If you take a look at the debt profile now for Nigeria, with the 600 billion that the Debt Management Office raised this month, added to what they've done for the whole year, that's 9 trillion already in just 4 or 5 months of the year. So we did 10 trillion last year, and they've done like 9 trillion in 4 or 5 months. So that's a big red flag, and if you take a look at the borrowings, external borrowings, and all the commercial bank loans we're taking, those commercial bank loans are not appropriate for the purpose. So the sort of financing we're looking at is beginning to get desperate, if you ask me. And when financing gets desperate, that means that there is something that is amiss. There's a red flag. We need to take several steps backwards because our debt profile is becoming, or has become, not is becoming, has become unsustainable. Because if you add all these additional debt factors into it, you take a look at the debt to revenue ratios now that had come down before, they're now approaching 90%. So for every 100 naira we earn, we're using 90 naira for debt service. That is not sustainable, and that is why this government has not been able to fund its capital expenditure for the last 3 years, and that is definitely a source of concern. So because of this situation, the monetary authorities will respond appropriately. So the reduction in the interest rates that you say Nigerians are asking for is desirable. I don't think any central bank wants to keep interest rates high for the sake of keeping it high. It's a compromise. You cannot borrow at 35% and grow the economy. If you're borrowing at 35%, that means you're going to have more bad loans. A lot of the banks have just raised capital. So where do they deploy this capital? The federal government is now beginning to crowd out the private sector in terms of borrowing. So what you now find out is that all the fresh deposits and all the fresh capital these banks have raised, first of all, 45% of that money is going to the central bank in the form of CRR, without a doubt. Central bank is taking that. And then how much is available to lend? So the monetary authorities will respond accordingly. I've always said it, if you want to take a look at the state of any economy, take a look at the monetary policy situation, and that will tell you what the fiscal side is doing. So it is very important that in order for the monetary authorities to be able to drop interest rates, there has to be some improved fiscal discipline. Right now, we lack that fiscal discipline. The budget is not transparent. It does not say clearly how there's no financing plan for the 35 trillion deficit, and we have not seen an articulation of growth strategies. The coordination between the industrial policy, the trade policy, and the investment policy is missing. And that is something that's very, very important. And the stimulus for growth is not there. So that's why we are saying that the reform gains that we've made is under threat. So there's something that you can do to stabilize the economy, but then you need to transform the economy. There needs to be productivity. There needs to be gains in employment. 140 million Nigerians are in poverty. The only way you can get them out of the poverty is to be growing the economy at 8 to 10% on a sustainable basis. We are projecting that because of the changes in the oil and gas industry, that is expecting about an $18 to $20 billion inflow, improved rig counts, the mining sector and the recapitalized banks, we believe will drive the economy to over 5% growth this year. But that in itself is not sufficient. But at least we're growing and we're out of stagflation. But a lot of work still needs to be done in terms of coordination.
Yeah,
and I think that is why I say that the monetary policy, they have an 11% margin in terms of the differential between inflation and the MPC rates. So I think that because of that, I believe they will hold the rates.
All right, Mr. Adebayo, you talked about fiscal discipline. Now, there are so many aspects to it. You talked about the budget, the deficit there. What, in your view, do you think can be done at this time? We're in a tight corner now because of what's going on, the geopolitics, and of course that's driving prices, energy costs, transport, and all of that. Now, we already have our budget for the year with this 35 trillion deficit. What do you think can be done by the fiscal authority now to give someone like you the confidence that perhaps these factors that are against us, threatening the gains of the reforms, maybe they're on the path of being straightened out?
First of all, I think we need to be more realistic with this budget, because you're not going to meet those targets. So I think maybe you need to review your budget downwards. I think that is very, very important, so that there's more reality into it. I think they've been operating 3 budgets, and I think there was just the pressure to be able to consolidate all those 3 budgets into one, and they just moved all the outstanding capital budgets and just pushed it into this budget. But then it doesn't reflect reality, which is really where the situation is. And what is really the plan? What is your goal? What is your objective? Because all these reform gains we're seeing, the fiscal management and the fiscal discipline is not there. So if you ask me a question, one of the biggest challenges we have in Nigeria is that because, as you said earlier, because we have sold a lot of our oil forward, we cannot benefit from the $100 price increase. This should be a time when Nigeria should have a windfall, and with those $100 barrel prices, significant windfall that will help us, clear a lot of our backlog, pay down a lot of our debts, and restore our balance sheet and restore the capital structure of the government. But because you've made bad financial decisions consistently over the years, you cannot benefit from this. I believe I'm not a fan of these forward contracts because they're not favorable to us. The differentials on these contracts, I don't know the difference, but these differentials we're seeing, I don't know the details, but if there's a differential, should it not be used to pay down these loans? But we do not have the barrels, and that's the reality. We also need to remove the vulnerability of our economy to global headwinds as an oil-producing nation. All the other oil-producing nations you're talking about, Norway, UAE, Saudi Arabia, all have significant sovereign wealth funds. The Norwegian sovereign wealth fund is closing on $2 trillion in valuation, and last year delivered close to $200 billion for the government. Same thing with the Saudis. So because of the cyclical nature of oil prices, they've hedged out. These oil prices, whether it's going up or down, do not affect these nations anymore. In 2019, when we had the global financial crisis, Nigeria had $25 billion in excess crude accounts. It was this money that helped us through the global financial crisis, and we're able to create a buffer against these global headwinds. But what happened to the money? 2 former governors, Amici and Fashola, said that they should share the money. Now, the essence then was that these were monies that we should have kept into a sovereign wealth fund. We later created the sovereign wealth fund, but that sovereign wealth fund was not properly funded. And today, the sovereign wealth fund, the excess crude account is less than $100,000. And even the stabilization fund, which is supposed to help manage a lot of all these global shocks, is less than 100 million when you're facing 35 trillion deficit and closing in on about 200 billion naira in debt. So, the 200 trillion naira in debt. So this is a big challenge. And those governors that you are talking about, they eventually became ministers. And when they became ministers, they couldn't fund their capital budget. And what did they do? These ministers, when they were in government, they now went to the central bank and drew down close to 30 trillion naira in illegal ways and means financing. They printed money to fund their projects. These were two governors that say you should share the sovereign wealth fund. Nigeria is an irony. Now, all of a sudden, they now went and borrowed 30 trillion to start doing their projects and printing money. And that is why we're in the mess we are today. So today, we don't have the buffers in place. So we need to restore fiscal discipline and put buffers in place that will protect us from the vagaries of oil price fluctuations, increase and decrease. So that is really one of the biggest challenges in Nigeria today. So if we don't do that, the military authorities will only have no choice but continue to maintain high interest rates, and that is at the detriment of growth and development of the country. Yeah. It's a compromise.
Obviously. Well, not like it's new, but these are some of the issues the country has been facing, and talks are on. We do hope that one day we'll have enough action to back those talks and bring the benefits that we need. Well, thank you so much for your time on the program, the Chief Executive Officer of the CFG Advisory, Mr. Tilewa Adebajo, and enjoy the rest of your day, sir.
Thank you.
All right, let's take a break now, or rather, let's tell you what PENCOM is doing. Yesterday, the PENCOM Commission, they were in Lagos to meet with the Nigerian Labour Congress, the Lagos chapter, and it's about the contributory scheme, the pension contributory scheme, and how much has been adopted. Talking about discipline, Mr. Adebajo talked about, this time in the private sector, about the contribution and the counter-contribution. Well, of course, as expected, it's not going as straight as we would have loved for it to be, but here's the report. The National Pension Commission, PENCOM, is holding an interactive session on the workings of the contributory pension scheme for the executives of the Lagos State chapter of the Nigerian Labour Congress, as part of its ongoing stakeholder engagement framework that's aimed at strengthening transparency, trust, and collaboration in the administration of the Nigeria's pension system. The union lays down their complaints experienced by members.
Despite monthly deductions from workers' salaries under the contributory pension scheme, many employers have deliberately failed to remit these funds to the appropriate pension fund administrators, PFAs, thereby jeopardizing the future and the retirement security of hardworking Nigerian workers. The non-remittances of pension contribution constitute a gross violation of labor laws, an abuse of workers' trust, and an act of economic injustice against employees.
Well, we apologize for that incomplete report on the pension contributory scheme. We'll now take the full report before we head to our next conversation. The National Pension Commission, PENCOM, is holding an interactive session on the workings of the contributory pension scheme for the executives of the Lagos State chapter of the Nigerian Labour Congress, as part of its ongoing stakeholder engagement framework that's aimed at strengthening transparency, trust, and collaboration in the administration of the Nigeria's pension system. The union lays down their complaints experienced by members.
Despite monthly deductions from workers' salaries under the contributory pension scheme, Many employers have deliberately failed to remit these funds to the appropriate pension fund administrators, PFAs, thereby jeopardizing the future and the retirement security of hardworking Nigerian workers. The non-remittances of pension contribution constitute a gross violation of labor laws, an abuse of workers' trust, and an act of economic injustice against employees who have faithfully rendered services to their employers.
Apart from dealing with the concerns of the union, the meeting is expected to improve clarity and alignment on pension-related issues, strengthen collaboration between PENCOM and the Lagos State NLC, increase support for pension compliance and reforms, and also enhance confidence in the management of pension funds.
It's a smart mode of making remittances. So what we're trying to do is to put in place a system, okay, that is uniform. If you look at one of the objectives of the pension reform 2040 is to make provision for uniform set of rules, regulations, circulars for the administration of pension in Nigeria. And in putting that in place, we decided that okay, let us have a uniform platform where all the players of labor who wants to remit pension contributions can make those remittances.
Similar meetings are planned in other parts of the country to boost knowledge and adoption of the pension scheme. All right, so that's pension and what they are doing to get more adoption into the contributory scheme. And obviously, every worker needs to know that even after work, after your energetic days are over, you can still live a good life, and that's what pension is supposed to do. Now, so we do know that today is interest rate meeting day. That's the MPC by the CBN, and interest rate is at the core. But there are some banks that say they are non-interests. So I know you've been hearing of them. There are a couple of them already in existence. Some major ones that we know now are Jai's Bank, Taj Bank Limited, Lotus Bank, Alternative Bank. These are the major ones in existence in Nigeria now. And over the years, we've seen growth in their assets. Talking about these non-interest banks, we've seen that their assets has crossed 1 trillion naira in recent times. They've expanded. There's been increased financial inclusion. Ethical finance demands to cook. We've known Sukuk for a long time, even before we start having these non-interest banks. We've seen the federal government use it for a lot of infrastructural development, and then we've seen digital banking adoption. I think most of them are digital banks, and the financing models that most of them have used is Murabha, that's cost plus financing. That's one model. There's Mudaraba, that's profit sharing. And then there's Ijara, leasing, and then there's Sukuk, which a lot of us know, Islamic bonds. There's Wakala, agency financing. And, they're supposed to drive SME growth and reduce poverty, also deepening financial inclusion. Right here in the studio, we have the co-founder and chief executive officer of STEX, Financial Technologies Limited, Mr. Habib Bailey, to help us understand some of this. Mr. Bailey, good morning. Welcome to the program.
Good morning. Thank you for having me.
I hope I didn't murder some of those names.
No.
Small. All right. So non-interest banks, does it mean they are not affected by meetings such as, what the CBN or the MPC is doing today to determine interest rates? That doesn't concern them at all.
Not necessarily. The MPR also, or the MPC meeting also affects the non-interest banks, because some of the financial instruments that they use in carrying out their day-to-day activities, like the Murabaha you mentioned, is a cost-plus kind of financing, and in most cases hinges on the movement of the MPR, right? And the same thing with the leasing contract, which is the ijaro. So it's also as equally important as for the conventional. And the non-interest banks use this as a benchmark to determine the price they set for their financing activities. So, yeah, very, very important.
So I know, like, for instance, the microfinance banks are supposed to deal with small businesses, but their rates are really high. Yeah. So does it mean that small businesses can turn to the non-interest banks, or what are the requirements, that could be a hurdle to full access of funding from non-interest banks?
So for microfinance banks, or even the commercial traditional non-interest banks, the requirements are similar. But for some of the microfinance banks, because unlike the traditional banks, they don't probably seek collateral, so their pricing are a bit higher, right? And because of the pricing are higher, it's a bit of a stretch for the businesses that seek those financing. So at the end of the day, you'd realize that for the business, they have to decide which one would they go for. If they have collateral, then the commercial banks, the traditional non-interest banks, would look more palatable to them. But without collateral, they might find the microfinance or perhaps other financial, non-interest financial institutions, or those that provide credits, more attractive because they don't have to drop collateral.
But there's a cost. There's a cost to every fund. So what's the cost?
And the cost is because they don't have collateral. The rate at which the financing comes might be a bit higher.
That's for the non-interest banks?
Even for the non-interest banks, right? So the other part is that for the non-interest bank, it's not just the markup. You also have the profit-sharing models, where the banks look at your business case and they partner with you to finance a particular venture. Whatever profit that is made out of that business, you both share it, and whatever loss that is made, you also share the loss.
I think that's the one that's called Mudaraba.
Exactly.
Mudaraba, okay.
Yes.
So is it for startups, existing businesses, or what level of business could do this profit sharing with the bank?
So first and foremost, usually the banks determines the kind of financing instruments that they use.
Okay, so if a business approaches the bank, then the bank would, assess the business and then propose different types.
And I think that's part of the beauty, right? You need to understand the business needs, and from the varying financial instrument that you have, you propose a particular one. For instance, there are businesses that maybe they need working capital. You could go and you think using the cost plus, which is the Morobaha, might not be attractive or suitable enough for that business. Then you determine the kind of financing that you use. For instance, we have for our organization, we have a subsidiary that is SEC licensed. We try as much as possible to also advise some of these businesses. Then, based on the advice and the suitability, we send them to our lending arm to provide this financing. So, at the end of the day, what determines the kind of financing is the current need of the business. And I tell people a lot that this is one of the beauty of non-interest finance. So you could use the Morobaha, which is cost plus, particularly for businesses that are trying to finance their inventory, or they're trying to finance an asset, right? You could use Ijaro, which is the lease kind of financing. Maybe you want to buy an equipment. So Ijaro could be more suitable because the bank holds that particular asset in its own name, and they lease it to the business. So the business uses it for a particular period, and the bank eventually sells it. And there's a great deal of benefit in these different financing models. However, a lot of people still don't know much about this instrument, though there's growing awareness about some of these instruments. And as you can see, I think this year, late last year, the Central Bank of Nigeria approved Bank of Industry to open a non-interest window. And the Development Bank as well is also doing a lot of work in that regard. So there's a growing momentum around non-interest financing in Nigeria, because if you look at, for instance, from a financial inclusion point of view, the northern part of the country, you found out that majority of them would not take interest-based financing. And that's why there's a growing interest in that space to see how non-interest financing can penetrate. Because based on EFINA statistics, while we have tremendous growth when it comes to financial inclusion in the southern parts, the northern parts, there's still a lot of work to be done. Apart from people being able to open accounts, the financing gap is
Yeah, because I
still...
wanted to ask, when we talk about adoption, if religion comes in, because as you noted, I mean, when you talk of non-interest bank, is Islamic financing,
Yes.
and is that a hurdle in the southern parts of the country?
Not necessarily, but it plays a part, right? And because there are people that would not necessarily take other forms of financing if they don't have the one that is non-interest, of course. While some people, whether it's non-interest or interest-based, they won't just go for it. We've come across businesses like that they prefer...
people who don't want to owe. I know that
exactly, they don't want to owe at all.
Yes,
they don't want to owe. They'll tell you that, I want to sleep well at night, right? So you have that category of people, and you have categories of people that, because it is interest-based, they won't go for it. And you have the category of people that, in as far as it is not interest-based, they're fine with it. So the overarching thing is that we need to be able to sensitize people more, the benefits for those that their business actually need this financing to eventually grow. For instance, we financed a particular business that was dying, started with about 10 million naira, right, and increased the amount over time. The business is now close to doing 1 billion naira, from a business that was close to dying to now grossing about 1 billion naira in revenue.
But how does non-interest banks, how do they deal with bad debts?
So it's almost similar to the way your conventional will do it, but there's a little bit of, should I say, respite. So for instance, if an Islamic bank finances a business and the business defaults, right? The first step is to, as much as possible, try to see how you can recover it, right? And if it's proving difficult, of course, you have to probably try to classify it as bad debt or something. However, there is a penalty charge that Islamic banks are allowed to, of which they are not expected to earn from it. They are to give that proceeds to charity. These are some of the differences between the conventional and non-interest banks.
All right, thank you so much. Sounds interesting and something that we should explore further. Mr. Habib Bele, the co-founder and chief executive officer of STEX Financial Technologies. Thank you for your time.
Thank you very much, ma'am.
Let's take a break now. When we come back, we'll go global. Please stay with us.
Yes, good morning, everyone around the world. Here in Lagos, Nigeria, we're starting global news first with the European stocks, which struggle to gain momentum today as global markets keep a close eye on elevated bond yield and lower than expected UK inflation report. The pan-European Stoxx 600 was marginally lower, with sectors and regional bursts in mixed territory. In Asia, the markets fell across board as investors weighed elevated global government bonds and renewed geopolitical tensions. Meanwhile, U.S. stocks futures ticked slightly higher today. For details on Wall Street's trading on Tuesday, let's join our Washington correspondent, Mary Bird.
The U.S. stock market saw some major dips on Tuesday as the Dow Jones was down at 0.6%, the S&P 500 was down at 0.7%, and the heavy tech NASDAQ led the day down at 0.8%. Many investors were watching how the stock market was pulling back on the day, as it's clear that the easing up of the oil prices has also caused an impact on the U.S. stock market. President Trump's announcement that if there's not a deal soon, that we could see greater repercussions on Iran also had a major impact, as investors continue to watch to see the geopolitical climate and the economic impacts that it will have on the U.S. economy.
Our Washington correspondent Maribert giving us an overview of U.S. trading, U.S. stock market trading on Tuesday. And now we're talking about that UK's inflation is slowed to 2.8% last month, and that's the lowest rate in more than a year, as a reduction in the household electricity and gas bills helps soften the sharp rise in fuel costs since the start of the Iran war. According to the Office for National Statistics, ONS, the Consumer Prices Index eased from March's reading of 3.3%, suggesting the impact of the Iran war has not yet hit UK households as much as feared, despite prices at the pumps rising at the fastest rate in nearly 4 years. The reading beats economists' estimates of a decline to 3% and was the lowest rate since March 2025. And now, still talking about the UK, the government has relaxed its strict sanctions on Russian crude oil, allowing for the import of jet fuels and diesel refined in third countries amid surging costs. And the move is coming at a time of growing concerns over the supply of certain fuels due to the de facto blockade of the Strait of Hormuz since the start of the U.S.-Israeli and Iran war. And a trade license that came into effect today permits the imports indefinitely and will be reviewed periodically. And now, let's move over to India, where the Reserve Bank has intervened in the country's onshore currency market by selling US dollars to protect its currency, that's the rupee, which has dropped to a record low of 96 against the US dollar. And the decline was driven by surging global crude oil prices and significant capital outflows from Indian equities. At the same time, the RBI says it is actively keeping a close watch on intraday currency movements to prevent further rapid depreciation. Okay, so now let's head to China, where the country has indicated that it would accept increase in U.S. tariffs to a level agreed upon last year and would continue talks to extend a trade truce. And this is a sign that the ties between the world's two largest economies are further stabilizing. And according to latest statement made by the country's Commerce Ministry in Beijing, this follows last week's meeting between U.S. President Donald Trump and Chinese President Xi Jinping. Meanwhile, the ministry also says that the U.S. should further remove unilateral tariffs upon follow-up talks to create favorable conditions for expanding economic and trade cooperations. Now, let's talk about the wheat prices. Wheat prices have dropped on China's lack of confirmation of grain purchases. A massive game of geopolitical telephone has triggered a sudden retreat in global wheat prices. That's for the wheat market. Just 48 hours after a White House announcement of a massive farm deal sparked a historic rally, wheat futures are sliding. And the culprit? Silence from Beijing. This comes as traders realize that China has not officially confirmed the specific multi-billion-dollar grain purchases. The initial market euphoria is evaporating. And finally, on the global news, we have it that South Africa's International Trade Administration Commission, ITAC, has implemented and proposed wide-ranging steel import duties increase of 10 to 30% to defend its domestic sector from what it terms as unprecedented emergency. The measures aim to counter a massive influx of low-priced steel products, primarily from China and India, which are heavily undercutting our local manufacturing. However, ITAC says key steel-making raw inputs such as stainless steel will remain duty-free to lower production costs for domestic specialty manufacturers, while rebates remain available for non-locally produced items. And that's global news for Wednesday. I'll see you again tomorrow.
Thank you so much, Anita. And just before we head out of the studio this morning, taking you to the markets, Nigeria's local bourse, we see a slight drop in the oil share in early trade, just 0.01%. That could be recovered at any moment. But I guess Japan Gold, we see yesterday trending is still on this morning. It's up more than 8% in early trade. Nigerian Exchange, the parent body of all the trade, is also positive. Gets a bit of attention this morning, 0.78% of Jaiz Bank, one of those non-interest bank which we discussed. Well, that's also positive this morning. Access Holdings is still positive. However, we see continuous drop in Geregu. Just this morning is lost 10%. Which is the max that any stock can lose in a single trade. Beggar Paint is also down. Okomu Oil Palms, FTN Cocoa on the other side we see is positive. That's what happened yesterday. But Okomu is down. Unfortunately, we won't see the intraday. Oh, yeah, we can see the intraday numbers at 1:30. But it's MPC Day today. That's our focus. At 1:30 during Business Incorporated Special. We'll talk about what to expect from the MPC, and then we'll head to the Central Bank headquarters, and then we'll analyze their decision. That'll be at 1:30. I'll be back. Let's make it a date. I'm Amy John Mekwa.